Hello, class. This week we will be going over partnership taxation and S corporation taxation. The reason these two are combined is that they're very similar in a lot of ways. There's a few key differences, but both of them have a tax filing requirement. Both of them spit out a K-1 showing a partner or shareholders share distributed income, losses, capital gains, foreign taxes paid. So the form that it spits out is substantially the same, which is why we're combining them, is that they're alike in more ways than they're not alike. So the first chapter we're going to be going over is partnerships. So here we've got chapter 9, partnership formation and operation. Our learning objectives are, and there's a few of these, compare and contrast the various partnership forms, describe the basic concepts of partnership taxation, explain the tax results of contribution of property or services in exchange for partnership interest, establish the permitted tax year for a partnership, distinguish between items included in partnership ordinary income or loss and those that must be separately stated, determine a partner's distributive share of partnership income, gain, loss, deduction, credit items, calculate a partner's basis in a partnership interest and its effect on losses allowed, discuss the at-risk and passive activity loss limitations, determine the tax consequences of property sales between the partner and the partnership and guaranteed payments to the partner. And finally, recognize the special tax issues associated with family partnerships, identify planning techniques to get the best tax advantages for partnership losses, and finally, comply with the requirements for filing a partnership. So before I hop into this, I'm going to give you a little background on partnerships. They are largely ruled by the 700 code section of the Internal Revenue Code, the IRC. So you're going to see a lot of 700 code sections during these slides. Partnerships came around a while ago, and it was presented with a really simple premise. It's two people going into business together. The problem with that is that there were various loopholes that came about and had to be closed. So it kind of built on itself where there's all these loopholes that had to be closed. So all these special rules that apply. And so it becomes this kind of tapestry of various rules, various loopholes that are closed. And now this means something else. And partnerships are maybe the most complex form of tax entity that someone could choose. Partners can now be corporations, trusts, estates, individuals, and it's really built on itself where it's just inherently confusing. You've got inside basis, you've got outside basis, partnership interest. It's just a really complex tax entity type. I personally don't like partnerships, but I don't like them because I have to do the reporting. They are incredibly flexible for individuals, estates, trust corporations, kind of like I mentioned before. And there's a lot of good you can get out of it. The main downside is, a general partner has unlimited liability in a partnership. But you can kind of work around that with an LLC designation. There's going to be a lot of rules to it, and they might not inherently make sense, but understand kind of where it came from, and that they came around a long time ago. There's a bunch of loopholes that people were exploiting, so these loopholes got closed, and it just becomes inherently confusing. I just want to give you that heads up before we get too far into this that I occasionally still have to go back and Google inside basis versus outside basis. We'll get into that in these slides, but I just want to give you a heads up that you might be confused on these. All right, so let's get into it. Okay, so partnership formation. So you've got partner A contributing property, you've got partner B contributing money. Basically, all you have to do to contribute to a partnership is provide some sort of asset. That could be property, cash, equipment, services. Services get treated a little bit differently, kind of like we discussed last week, but it doesn't take much to form a partnership entity. It's two people going into business together. And before I get too ahead of myself, I'll regale you with another story. I had a client who, she didn't tell me this, but 2 years before I was working on stuff, she had formed a business with a colleague of hers. And he was reporting half of the profits on his Schedule C. And I had to tell her that that's not how that works. This is inherently a partnership. Your partnership agreement specifically calls out the 700 code section, which is what governs partnerships. So, right, the partnership agreement specifically calls out these code sections. Okay, you're a partnership. Had to fire her as a client because she refused that she was a partnership. She thought it was split half the profits on the Schedule C. Not how this works. You got two people, individuals, corporations going into business together. Unless they elect to be an S corporation, they're a partnership. So I just want to give you the heads up that some people are going to try to throw some weird stuff at you, and it's up to you to know better. But anyways, getting back into it, here we've got partner A with property, partner B with money. They both contributed assets of some type. They both have a 30%. Okay, so general versus limited partnerships. We kind of covered this last week, but general partnerships, we can make binding decisions for entity, has unlimited liability for partnership debts, one of the downsides. Can potentially lose personal assets, another downside. And then limited partnerships, you got to have at least one general partner and a limited partner. And the limited partner can potentially lose only up to the investment plus any committed amounts. This is where the LLC designation can kind of come in handy. You can kind of circumvent this a bit. General partnerships are essentially management, right? They're kind of running the day-to-day. Limited partnerships are inherently more passive. They're not involved in the day-to-day management decision. So here we've got types of limited partnerships, limited liability, limited partnerships, the LLLP, limited liability company, treated as a partnership with tax, has limited liabilities of a corporation, right? It's kind of the marriage between the two. Tax treatment based on check the box, you check the box that you're balancing. And limited liability partnerships, similar to an LLC designation. And that's more of a legal entity type than it is tax so much, right? It's if I'm filing a 1065 for a partnership, and if it's an LLC or if it's a not, my answer doesn't change. But the owners would have more protection under the LLC designation. Partnership profits and losses. So here you can see we've got income deductions, tax attributes going to the partnership, and then that gets spit out on the K1 and it's allocated to the partners distributed. Calculating partners basis, it is what you contribute, and then you add your income or your increase in debt. And the increase in debt comes from the logic that because you have unlimited liability in this partnership, if you have debts as well, that should be treated as basis, right? If they can come after you potentially with unlimited capacity, increases in debt should also increase your basis. And then we subtract off losses and debt payoff, and that's how you get to your ending partner's basis. And we've got some examples. So Tom buys a 20% interest in XY partnership for $8,000 on January 1st and materially participates. XY partnership has 2,000 in liabilities. The following year, XY takes on 4,000 in additional debt and a $10,000 loss. So here you want to pay attention to the 8,000 he contributed and the fact that he has 20% interest. So calculating Tom's basis, we look at his initial contribution of 8,000 plus his share of the debt, which is the 2,000 here and 4,000 here. Multiply that by 20%, that gets us 20. And then his share of losses, which is 20% of 10,000. So we have to back that up. So his ending basis is 72. We'll get into it, but I just kind of want to cover it quick. Your basis can never go below zero. So you can't have negative basis. The least you can have is zero. And if you take distributions in excess of basis, that amount has to be recognized as. Otherwise, it's kind of viewed as a return of capital. You know, if Tom were to take a 5,000 distribution here, his ending basis would be 2,200, and he would get that 5,000 tax-free because it's a return of capital, right? His basis was 7,200. He took out 5,000, it decreases his basis, but not to zero. If he had taken out 10,000 in distributions, then he would have to recognize gain in excess of basis. And it's getting into these slides here, but I just kind of want to touch on it. Non-liquidating distributions, non-taxable to the extent of basis, right? That's the 5,000. It's considered a return of capital, right? It's a reduction of his basis. Excess over basis, taxable gain, that's distributions of excess basis. Example, XY distributes to Tom 9,000. Tom has a gain of 1,800. It's fairly simple in theory. Forming a partnership, so no recognition of gain or loss upon partner's contribution of property in exchange for partnership interest, section 721. Again, partnerships are pretty much designated by the 700 section. The logic behind this general rule is that the partner didn't really gain anything, right? They traded one asset for another asset. They're not in a position to pay necessarily because there's no exchange of cash, really. Services are not property, so ordinary income recognized fair market value. Similar to our section 351 discussion last week, non-recognition provisions apply upon later contributions of property if the partnership has been formed. Exceptions to the non-recognition rule, gain or loss is recognized if the partnership is considered an investment company. Pre-range contribution distribution scheme, and partnership assumes partner's share of liabilities and exceeds partner's basis. I do kind of want to touch on the second one here. So what that's really saying is it's a disguised sale. So a pre-arranged contribution distribution scheme, if you have someone that contributes $10,000 of land to a partnership, and the partnership in turn pays that partner $10,000 for that land, that's a disguised sale, right? It's that distribution of 10,000 would have never happened if the partner hadn't contributed the land of 10,000. So that's where they're saying that, yep, you know what, this is actually a sale. You sold this partnership to, or you sold this land to the partnership. You need to recognize it's a pre-arranged, it's a disguised sale. It's not an exchange for partnership interest. It's you sold land and you got money for it. So you got to recognize that. Here we've got an example of impact of liabilities on a partner's basis. Mary contributes land in exchange for 20% partnership interest. Partnership has 4,000 in liabilities. The fair market value of the land is 60,000. Her basis is 30. Mary's liability on the land, which is assumed by the partnership, is 50,000. So here is the partnership has carryover basis for Mary, so you get 30,000 in basis. Mary's share of the partnership liabilities, which is 20% of the 4,000. Here you see 20%, 4,000. That's a gain of 800. Mary's debt assumed by other partners because she had liability is less 40,000. Mary's basis in her partnership interest is 0, right? It can't go below 0. So Mary recognizes 9,200 gain. And this is a pretty good example of how this plays out. It's partnership gets carryover basis. Mary recognizes her share of the partnership liabilities. She has to deduct, or I guess remove, the debt assumed by the other partners. It was all on Mary. Now the partnership is assuming it, so all the other Mary's partners. So that has to be recognized by as a reduction to her basis. And then her basis drops to 0, so she has a gain. The character of gain, partnership assumption of partner's liability is equal to cash distribution. The partner must recognize gain. The character is determined by partnership rules. Therefore, any gain recognized because of partnership distribution in excess of one basis, that's capital gain, right? So it's, in this example here, Mary would recognize this as a capital, the 92, which gets, assuming it's long-term, gets preferential tax treatment. Short-term gets calculated at ordinary rates. Long-term has preferential rates. So it's not necessarily a bad deal for her, but she's got to recognize it. Partners basis and partnership interest outside basis. So you add to contribute cash, carryover basis of contributed property, recognized gain, and the partner share of partnership liabilities. So outside basis refers to a partner's share of the partnership. Inside basis refers to the partnership's share. Holding period for partnership interest, partners holding period of contributed property tax to partnership interest, kind of what I went over just a bit ago. Property must be capital asset or 1231 property. And we have an example. Sue contributes building she's owned for 5 years to a partnership in exchange for 20% interest. Holding period in business in that building transfers to the partnership. So the partnership would have essentially 5 years of ownership of that building because Sue had it. Partnership basis and property, general rule, section 723, again, the 700 section. Partnership assumes carryover basis of property contributed by partner. If gain is recognized by partner, because partner is an investment company, partnership increases basis of property. Similar to section 351, in examples where the partner or the shareholder had to recognize gain, right, because they didn't meet the 80% control requirement, that added to their basis. Similar situation. Gain recognized by partner because of assumption of partner liability does not increase partnership basis of property. It would increase the partner's basis, but not the partnership's basis. And this is where partnerships start to get confusing. It's kind of the inside versus outside basis. Partnership character of gain, general rule, character of gain or loss, tax upon disposition of contributed property, example, contribution of inventory to partnership is still ordinary income when it's sold by partnership, right? If I contribute inventory to a partnership, it doesn't change my gain. It's not capital, it would still be ordinary income because that's what it was before. It doesn't change. Exception to general rule, all gain loss is treated as ordinary for any property contributed within 5 years of disposition, right? So if I contribute land and by 3 years the partnership sells it, that's ordinary income. That's not a capital gain. That's now ordinary. Same thing with it. Capital loss property. If a partnership sells within 5 years contributed property with the built-in loss, then any loss is capital in nature. Capital loss is limited to the built-in loss. Character of loss over the built-in amount depends on character of property and partnership. Got other partnership issues. Partnerships holding period tax from holding period contributed property, kind of already covered that. Partner does not have 1245, 1250 depreciation recapture upon contribution unless recognized gain. Character tax to partnership upon later sales of property. So that means that if I've got depreciation on an asset I'm contributing, I don't recognize that from contribution of services for partnership interest. Kind of covered this a bit last week, section 351. You got to recognize the income if it's for services provided. General rule, partner must recognize income, fair market value of capital interest. Fair market value of capital interest is equal to the amount the partner would receive if the partnership liquidated. If partner receives only profits interest, then interest income is recognized when received. That is the other thing about partnerships is the partnership agreement pretty much spell out whatever you want. You could be subject to 10% of the profits of a partnership, but you could be subject to 50% of the losses if that was the way the partnership agreement was written out. It's not necessarily I'm recognizing 10% one way or the other. You can get really creative and really specific with partnerships. And that's what this last point is kind of hitting on. The partner receives only profits interest. You could have it where you recognize only income and you don't recognize any losses, right? The losses would be recognized by other partners. Anyways, moving on. Partnership can deduct the payments for services in the same year the service partner recognizes income. That's the matching principle. Partnership allocates expense to partners other than the service partner. When partnership issues interest in exchange for services, it has sold a proportionate share of assets in exchange for the services. Right? If we've got two partners and they each own 50% of the assets, and we're admitting a third partner, I have to recognize that my basis in that asset goes down, right? I had a 50% share of it, essentially. We're admitting a new partner. So they have to recognize some share of that asset. They're now a partner in this partnership. And it was just two, now it's three. We have to recognize that, right? They would also get a share of that asset. Must recognize gain loss on percent of assets sold. The basis of the partnership assets must be increased, decreased by gain loss recognition. This is going to look very familiar because the rules don't change, but organizational costs must be capitalized and amortized over 180 months. Costs include legal fees, accounting fees, filing fees, etc. Right? This is the setup cost. Syndication promotion fees not included with organizational costs. Partnership can elect to currently deduct up to $5,000 in organization. Right? The rules are the same, right? As you would expect with an S corporation or a C corp. You don't get to recognize all these expenses up. So here we've got various partnership elections, and this is made at the entity level, which means it's got to be made on the 1065. So you've got year-end, inventory, depreciation, and all others not specifically reserved at the partner level, right? The partnership has to elect this. Year-end, which we will get into, is determined by who has the controlling interest in the partnership. If it's a C corp with a 630 year end and they own 75% of the partnership, that partnership has a 630 year end. That's the deciding factor, is who's in control of the partnership, because then it follows their tax, which we're getting into right here. Partnership tax year must elect the same tax year as majority interest. That's section 76. If majority interest tax year can't be used, other methods are available. And then we've got the section 444 election permits partnership year end with deferral of lesser of current deferral period or 3 months. Generally, what you see is that the majority interest kind of rules what the tax year is. I'm going to stop this video here because I've been talking for a bit, and we will continue in another video.